Hey, everybody, welcome back to another beautiful day in real estate. Today's going to be a perfect day to sit down and discuss what is going on and the financial crisis that is ahead of us. And I'm smiling. Only reason I'm smiling is because we have set ourselves up for when this does happen. We're going to be prepped and ready for some of the toughest years that our generation is going to see. I mean, things are tough now, but from what I'm about to show you, it's going to get a whole lot worse before it gets better. And this is, again, why I'm always going to be adamant about purchasing real estate and not keeping your money in the stock market. We have been tricked to believe that putting your money into paper assets is the way to go over the most recent years because we saw such an increase in real estate, saying it's overvalued. Today, I'm going to discuss with you why the real estate market is not overvalued and why the stock market is going to be the reason the market crashes, not real estate. So let's jump in. First off, interest rates are starting to come back down continuously. Small amounts, but we're still seeing smaller amounts kind of trickle down. 10-year Treasury bonds are bumped up slightly. Let's jump into those real quick. 10-year Treasury bonds. We saw a nice little fall off last week, which was really, really needed. And it was because up here is right where they were saying there's a deal imminent. There's a deal imminent with Iran, right? Just like they did here and I think right here. No, that's February. So here, and here. Those are the three, right? So interest rates are moving down slightly because bond prices dropped. Now we just have to get an actual peace deal put together with Iran. When that happens, then we are off to the races, right? Now, I'm feeling more optimistic again because from a technical point of view, this is WTI crude oil on the daily chart. Again, we do this on the daily chart for 3 days of expectation. I focus on the next 3 days, the next 3 months, and the next 3 years. I don't focus on anything past that because right now, relatively, the best way to become good at your trade is to stick to the same routine, right? It's the same thing with gambling, and I know people are going to laugh at this, but the same thing with gambling, right? If you stick to the same strategy, you don't waver, you can make money. Not saying you always will, but that's how it works, right? Gambling is all about probability, just like being in the stock market or understanding economics. It's probability, right? So we saw the all-time high, or not all-time high, but the local high of about 100 and what did we get to? Like 120 bucks a barrel almost. Holy crap, I'm twitchy today. Yeah, basically 120 bucks a barrel. Then we saw a slightly lower high, which peaked out at about like what, 116, 117. And then we saw a lower high, and then we saw a drop down to the major resistance or support, I guess, at about $88 a barrel. It pumped up, and then this morning, we already are seeing a reverse hammer, which leads me to believe we are more than likely going to be heading down to our next stop, which is around $83 a barrel. Why? Well, because we have appeared to be getting very close to a result ending the war. And the reason I think we're getting close to this is not necessarily a political thing, but kind of a world economic thing, right? The reason is because we're getting to see countries now where they are getting their crude oil reserves plunged to the largest amount in history. So the reserves are collapsing around the world because 20% of the oil supply is now shut off. And until that opens back up, we're not going to see a normal thing anymore. We haven't seen that normality. Yeah, I can never say that. That doesn't even seem like a word. But we don't have a normal anymore. The norm is not here. And until we can see it, it's going to be an issue, right? So as soon as I pulled up that today, I saw following right before I went on, which was about 5 minutes ago, breaking Iran pledges greater ease for Japanese ships transiting the Strait of Hormuz. Okay, so what does this mean? This just means that countries are now getting to a point where they don't really have the luxury of waiting anymore. And there's going to be a point when they start transitioning and bring oil back through the Strait of Hormuz, and they're going to qualify it as a worldwide emergency. They're going to say, oh, the oil reserves are the lowest they've ever been, and if we don't get oil moving, then we're going to have problems with gasoline. We're going to have problems with anything oil-related product, right? So as we are starting to see already, they're starting to ease on this. We're getting very close to opening up those gates again. And if we open up those gates again, we're going to see a great opportunity for growth in the next 6 months. It's going to take some time to go back to normal because we have seen basically the transition has been basically April, May, and now we're moving into June and the Strait of Hormuz is still closed. So until that becomes open again, we're still going to see this resistance, right? And this is why I'm getting more and more cautious of the market. And it's not just that war in Iran that I'm focusing on. It is the amount of leverage that is in the stock market right now. So let's pay attention. Investors have now plowed $65 billion into leveraged and inverse single stock ETFs, the highest amount in history, Risk on, folks. Risk on. This is me explaining, understanding the blow off top is playing out in real time. The amount of money that is getting funneled into these because you continue to see above average returns. Now, this is why it's so dangerous. When you see above average returns, you're going to start seeing a lot more people that don't know anything about investing that are dumping money in. The next step is people will leverage, and they'll start to leverage their mortgages. They're going to start leveraging credit. They're going to start leveraging everything they have to dump money in, expecting to become a millionaire, a billionaire, whatever. And the problem that people don't know is they don't know when to exit. They put their money in, they leverage it, they anticipate you're going to see another 10 to 15x gain, and then the market comes collapsing down and crushes you financially and emotionally. I've been there. I didn't leverage, but I've been to a point where I had enough money invested where the market crashed because I wasn't paying attention, and I had that young mentality investor where I was focusing, oh, it's going to go up, it's going to go up, it's going to keep going up, and I kept adding money. On my first crypto that I invested in, it went up 100x. Okay, I put, I don't know, a couple $1,000s in there. Tons of money on paper. So excited about it. And then one morning I woke up and it was down 70% in an afternoon. I guess in a morning I woke up. But the point is that when you over leverage and the markets get so hot, you see insane gains very shortly, and then the market jumps down and has to re-regulate, right? That's where we're at right now. We're getting to that blow off top portion, right? Now, again, another statistic for you, 8.28 trillion is now sitting in money market funds. These are considered safe investments. Why? Because they're money market funds. They're liquid. You can put money in, you can pull money out. You should be able to transition back and forth very easily. When I talked to a financial advisor a few years ago, a buddy of mine, he told me that I said, I want to see a return, but I don't want high risk. He's talking about the money markets. He told me the money market's where you want to be. You're going to see an average of 5% returns on year over year, and it's a very safe investment. So a lot of people are transitioning to the safer investment on paper. But here's the problem. Now, these markets, I don't understand money markets to the full extent, so bear with me here. But when you invest into a market when it seems like it's going to be safe forever, is typically the worst time you should be putting money into it. $8.28 trillion. We are literally 25% of the national debt is invested in the money markets right now. Put that into perspective. That's an insane amount of money, right? Now, we are getting to the point where overvaluated companies is becoming more and more prevalent. It's becoming more and more like, it's like looking at a picture. You're like, oh, that exists. Most people don't really pay attention to it, right? Because we're so focused on spending 80 hours a week working so that we can work just hard enough to make enough money so that we could pay our bills and go on one vacation, go to the bar once a week, whatever the case is. And then we forget that there's so much more going on around us, right? We push out the noise and we just tunnel vision. Here's my life. This is what I'm doing. And this is what nobody's paying attention to. We're investing money because our financial advisors are telling us to, right? AI bubble hits the same concentration level that resulted in bursting of previous bubbles, including the dot-com bubble. So what happens is there's so much concentration on this particular niche, right? Why is the S&P running so heavily right now? It's not because the economy's doing great. It's because of the amount of overhype and anticipation there is for AI, just like in the dot-com bubble. Dot-com bubbles was when the dot-com era, the internet era started, and everybody believed this was going to be the next phase of life. And it did. It became the most pertinent thing that we use today. But the problem is when you overhype something before it's ready to get to that point is when the markets become very leveraged and very dangerous. Right now, companies are not meeting the amount of valuations that they are valued at. Meaning if a company is valued at $1 billion, it's not producing enough revenue to meet that criteria. It's just there's that much confidence in the market that there's $1 billion worth of valuation and the buyers are going to go away. Same with NVIDIA, AI chips, or AI relates to computer chips. When computer chips reach their peak, which they will, we're going to see a correction. There is it's not even a possibility, it's just reality at this point. And the longer we try to shove that back and put it in a corner and act like it doesn't exist, the more dangerous it becomes. We could factor in the private credit markets that existed came into existence after the 2008 crash. In late 2009, they created these private credit markets where you could invest your money in a safer asset, right? We're starting to see the cracks. In Q1, we saw major companies, Blackstone, BlackRock, God, there was a couple other ones off the tip of my head. I don't even remember. But they capped out the amount of money that you could pull from these funds, right? These funds are supposed to be liquid. They're supposed to be safe, right? Everybody's taught to believe that if you put your money in certain places, it's 100% safe. There's always a risk that comes along with it. And with the private credit market, out of the 45% or what, I don't remember the numbers off the cuff, but it was like 15% is the cap, the amount of money of people that tried to pull it out. So out of all the money they tried to pull out, only 15% of it actually came out of the market. Why? Because they're over leveraged just like everybody else. The banks, the investment firms, they don't have this capital on key because they understand that money needs to flow. The problem with that is when you don't have capital on hand and investors try to pull their money out, there's no capital to bring it back. It's like me trying to sell something to you. If you don't have cash, how are you supposed to pay for it, right? It's the same thing. You try to sell a stock or you try to sell a fund you're in. Say, no, on paper, I have $1 million. I want my $1 million back. And they're like, oops, actually, we only have $150,000 to give you. Sorry about that. But it says I have $1 million. Right, but we don't have that on tap. And they'll play it off as, well, we have to keep the market stable. We have to keep the market stable. And that's the problem. We're to the point now where we're over leveraged, not only in retail investors, but also in corporate investors, right? And when we see stuff like this, it makes me even more and more nervous, the things coming in the future. And you see blow off tops in other markets, right? Japan has crossed 67,000, Nikkei. I don't even try to get that one right. First time in history. Since the April 2025 bottom is up 118%, adding $3.4 trillion in market cap in just 14 months. 3.4 trillion in 14 months. Now, this market isn't as big as the U.S. market, where the U.S. market we saw like a 2.9 trillion added in 1 week for the S&P 500. But when we start to see major green candles like this, it starts to lead me to believe that guess what? Something's coming, right? And that's what I'm paying attention to right now. The markets are over leveraged. We're seeing abnormally large gains and no understanding of how we actually got to them, right? And then we see people over leveraging in AI saying it's going to just go up and up and up. It's not different this time. It never was. But you were convinced that because AI is taking over, that it's going to be up and up and up forever. You're going to see the same thing that happened in the dot-com bubble. People compare the real estate market to the dot-com bubble, but it's completely different. You're not talking about technology. You're talking about a hard asset. So technology always gets overhyped because when you see the new thing, everybody gets excited about it. The same thing happened with virtual reality during the 2021-2022 bull run. People got over leveraged into virtual reality because it was supposed to be this next big thing. Meta came out and they said we're creating our own virtual reality center, and they tried to showcase commercials and it fell off a cliff. Why? Because it wasn't ready. That's how technology works. The idea comes out, the protocol comes out, the first thing pops up, right? I mean, in crypto, you had all these projects that were working on metaverses, right? These virtual reality worlds where you're going to be able to put on a headset. Dude, I am a licensed virtual reality real estate agent, okay? It's not even physical property. I can literally sell people and make a commission in real money selling it in a digital goggle set, right? But we weren't there yet. If you see, there was a company that just dropped yesterday. I can't remember who it was, but they talked about bringing out their virtual reality glasses in the next by end of 2027. That's what happens, right? And the same thing with AI. Yes, it's doing a lot of great things, but it's not mature yet. It's still a very young child in technology. It's very unpredictable. There's a lot of things that are unanswered, and it's growing so significantly, so quickly that people think that just because it's going to go up forever. There will be a resistance, there will be a halt, and then we will see a correction. And that's why, again, I'm focusing on getting my money into real estate right now, because we have to look at the general perspective, okay? If we have a president who's in office that built their entire wealth off of real estate, okay, are you going to put your money in something that they literally build their entire wealth on, or are you going to invest in something speculative? Most of you are going to invest in something speculative because it's exciting. It creates energy. It gives you that rush, right? Like you're buying something, it's going to go to the moon, I'm going to make a shitload of money. And that's the problem. When you get into real estate is it's not supposed to be a quick return. It's a slow burn, right? You get into something, you pay down the equity, you gain some equity with it, and then, you pay down the mortgage, you gain some equity, you maybe create some cash flow with a rental property, and then over time, in a decade, then you sell that property and make money, right? That's how that works. And that's where a lot of people have become completely numb to the idea of investing. My tax guy I had last year, a couple years ago, I don't use him anymore, but he tried to convince me to move my money into higher risk assets because the market's doing well. I said, no, 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 I don't want that. I want slow money. He goes, you want slow money? Why? I said, because it's guaranteed. I don't need a fast return. I'm very well doing just fine without seeing a 100% return. Well, it'd be nice, wouldn't it? Right. But just like playing blackjack, there's always a risk that goes with it, right? So that's why it's so important to be paying attention and understand the strategy that you're focusing on. Now, I created this channel initially to start educating people on real estate. It has now transitioned into understanding the economy and how the markets work so that you, as a real estate agent or you as an investor, can set your money in the right place at the right time. And that's how we gain value. That's how we create wealth. It doesn't come from one night you wake up the next morning, you saw 115% returns, 1,000% returns. You might get lucky with a couple of them. You might, but most of you won't. And most of you are going to spend every dollar that you earned working your ass off for an hourly wage just so that you can say, I almost had it. I almost had it. And that's the problem. We have to bring you back and say, listen, put your money in a hard asset. Real estate will be digitalized, just like our wallets, just like everything else. You want to pay attention. The stock market is becoming digitalized slowly but surely. You're starting to see banks talk about using a digital transaction space where they're going to be transitioning money where it settles immediately using the crypto space, using the crypto rails, right? Those are the things we need to be paying attention to. And, I did see something yesterday where we started to see there again, we're sharing a correlation 26 versus 2008. 2008, we had all these foreclosures, which I'm looking at the data now, 800,000 filings in Q1 of 2009, the back end of the 2008 crisis, right? And then I compared it to Q1 of 2026. We have 118,000. Yes, they're up 26%, but look at the overall number. The overall number is about 8 times higher. And the highest it got to, I think it was 1.2 million in 2008. I don't quote me on it, but that was the number that I remember, right? We were up to a 2.2% peak of all U.S. housing units. Now we're down to 0.4% of all houses. A 6-year high, don't get me wrong, it's higher than it was. I'm not trying to lie to you and say it wasn't, but here's the problem. Unemployment is stable at 4.2%. 2009, 8.5%, rising quickly. Subprime collapse, toxic mortgages, affordability squeeze, and rising ownership costs. The affordability squeeze, yes, very important to pay attention to. However, how many people have those 3%, 4% interest rates on their home? A lot. That's, again, why you're not seeing the inventory. In bigger metropolitan areas, Denver is becoming very dangerous. Don't get me wrong. Austin, Texas, seen it. Daytona Beach, Miami, Orlando, New York is starting to see it. California is starting, it's still pretty hot out there, I guess, but Arizona started to see it. Portland started to see it. Washington, these big metropolitan areas, it's getting very unsafe to be there. It's getting very expensive to be there. And that's why these markets are starting to implode, because people just can't afford to live in major areas. But the thing is they factor in the big cities. They don't pay attention to the Midwest. They don't pay attention to the smaller cities, the smaller places. Dude, the market has been absolutely tearing in North Dakota. We have seen lower inventory, and my building side has been so busy, I've barely had time to sleep the last 3 weeks because people want to be in a home. They still can be in a home. Right now, North Dakota is still the most affordable state in the country right now versus average household income, yearly income versus living. Right now, it's about 36% of your yearly gross income or net income goes towards your mortgage. The correct amount should be around 30%. Now, don't get me wrong, it's still 5% higher, but look at other parts of the country. 40, 50, 55, 60% of their net income goes towards their housing. That just leaves 40, 50% left to pay for the remaining things. And then if you have any money left over, which most of the people don't, then you can go out and do something fun. That's why it's so freaking important to be paying attention to these things, right? Because the affordability crisis is just getting worse. With the Strait of Hormuz being closed and the war in Iran, and gas prices continue to go up, people are struggling. I watched a video the other day, a gal is in tears, right? Bags under her eyes, working 2 jobs, working 100 hours a week, still can't make ends meet. That's the world we exist in now, because we are transitioning to a different world. And the way that that's going to happen is with AI. It's going to happen with digitalizing things. And they're going to bring in this new American dream where you're going to feel like you are winning, but the reality is you own nothing. You are going to rent everything from your car to the house to the games, the storage that you use for your phones. Anything is going to be rented. And that is where it becomes dangerous. We're in a time now where everybody's trying to funnel their money into the stock market. Now, just imagine the amount of people in overvaluation in the stock market comes collapsing down because nobody does the due diligence. And people that are already struggling to make ends meet now have all of their investment, all of their savings collapse in front of them. What do you think is going to happen? That's what we need to be paying attention to. So for those of you that are looking to get into real estate, now is the time to start paying attention, because now is the time that you are starting. If you want to get into commercial real estate and you can create the capital, I know investors right now that are buying tons of apartment buildings that are at 20% occupancy, 30%, 40% occupancy because they have been mismanaged, they have not been maintained, and now they're buying them from cents on the dollar from banks because there's an implosion in commercial real estate. That is where money's going to be made. All of you can shove your money in the stock market all you want, but guess what? There will be a peak, and there will be one in the next 2 years. Could be this fall, could be next spring, could be next summer. I don't know, but it is coming. And when it happens, most of you are going to wish that you sold and bought into something that was a hard asset that's going to generate cash flow. It's not about return on investment. It's about cash flow and providing more money in your pocket. So even if the world collapses tomorrow, you're still going to have revenue coming into your bank account. This is important stuff that you need to be paying attention to if you want to succeed. Thanks for making it this far. Make sure to like and follow. We'll see you tomorrow.